Crucial financial literacy terms. Financial literacy is the foundation for making informed decisions about managing money, investing, saving, and preparing for future financial needs. Understanding key financial concepts is essential for navigating everything from daily budgeting to long-term retirement planning. This guide introduces 35 crucial financial terms that everyone should know, empowering you to make smarter financial choices. Whether you're just starting your financial journey or looking to enhance your knowledge, these terms will help you achieve better financial security and success. 1. Asset. Assets are anything of value that you own, such as property, savings, or investments. They contribute to your overall wealth and can be used to generate income or be sold in the future. Examples include cash, stocks, bonds, real estate, and valuable personal items. 2. Liability. Liabilities are financial obligations or debts that an individual or business owes to others. This includes loans, mortgages, credit card balances, and unpaid bills. Liabilities reduce a person's net worth as they represent the money that needs to be repaid to creditors. 3. Net worth. Net worth is the difference between your assets and liabilities. It's a measure of your financial health. A positive net worth means you own more than you owe, while a negative net worth indicates that your debts exceed your assets, signaling a need for financial improvement. 4. Income. Income refers to the money an individual or business earns. It can come from wages, salaries, investments, businesses, or other sources. Managing income effectively is essential for budgeting and financial planning, ensuring there's enough money to cover expenses and build savings or investments for the future. 5. Expense. An expense is any money spent on goods or services. This includes everyday costs like rent, groceries, and utilities, as well as discretionary spending like entertainment or dining out. Keeping track of expenses is crucial to maintaining a budget and ensuring that spending doesn't exceed income. 6. Budget. A budget is a financial plan that tracks income and expenses over a set period. It helps individuals or businesses allocate funds efficiently, save money, and avoid overspending. By sticking to a budget, you can manage your finances better and achieve long-term financial goals like saving or investing. 7. Savings. Savings refer to the portion of income that's set aside for future use, rather than spent immediately. Building savings is important for financial security, providing a cushion for emergencies or big purchases. Savings can be held in various accounts, such as a savings account or retirement fund. 8. Investment. Investments are assets or financial products purchased with the expectation that they will generate income or appreciate over time. Common investments include stocks, bonds, real estate, and mutual funds. Investing is a way to grow wealth, but it comes with risks, as the value of investments can fluctuate. 9. Interest. Interest is the cost of borrowing money or the reward for lending or saving it. When you take a loan, the lender charges interest as a percentage of the borrowed amount. Conversely, banks pay interest on savings accounts, rewarding you for keeping your money deposited with them. 10. Inflation. Inflation is the rise in the prices of goods and services over time, which reduces the purchasing power of money. As inflation increases, each dollar buys less than it did before. It's important to consider inflation when planning long-term financial goals, such as saving for retirement. 11. Credit. Credit allows individuals or businesses to borrow money or access goods and services with the agreement to repay the amount later. Credit is essential for major purchases, like homes and cars, but should be managed carefully to avoid excessive debt. A good credit score is crucial for favorable loan terms. 12. Credit score. A credit score is a number that represents an individual's credit worthiness, based on their credit history. It helps lenders assess the risk of lending money. A high credit score can lead to lower interest rates and better loan terms, while a low score may result in higher costs. 13. Debt. Debt is the amount of money borrowed by one party from another, typically to be repaid with interest. It can be in the form of loans, credit card balances, or mortgages. Managing debt is crucial to financial stability, as excessive debt can lead to financial strain and difficulty in repayment. 14. Loan. A loan is a sum of money borrowed from a lender, usually with the agreement to pay it back with interest over a specific period. Loans are used to finance major purchases like homes, cars, or education. They come in various forms, such as personal loans, mortgages, or student loans. 15. Mortgage. A mortgage is a specific type of loan used to purchase real estate, with the property serving as collateral. Mortgages typically have long repayment terms, often 15 to 30 years. The borrower makes monthly payments, including principal and interest, until the loan is paid off or the home is sold. 16. APR, annual percentage rate. APR is the yearly interest rate charged on borrowed money or earned on an investment. It includes both the interest rate and any additional fees, giving a more accurate picture of the cost of borrowing or the return on an investment. A lower APR means lower borrowing costs. 17. Dividend. A dividend is a payment made by a corporation to its shareholders, typically from its profits. It's usually paid quarterly and provides investors with a steady income stream. Companies that pay dividends are often stable and well-established, making dividend-paying stocks attractive for income-focused investors. 18. Stock. Stock represents ownership in a corporation. When you buy a share of stock, you own a small part of the company and can benefit from its growth through capital gains and dividends. Stock prices fluctuate based on the company's performance and market conditions, making them a key part of investment portfolios. 19. Bond. A bond is a debt security in which an investor lends money to a corporation or government in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are generally considered safer than stocks, but they also offer lower potential returns. 20. Capital gain. A capital gain is the profit made when an asset, such as stocks or real estate, is sold for more than its purchase price. Capital gains are subject to taxes, but they're a key way to build wealth. Long-term capital gains are often taxed at a lower rate than short-term gains. 21. Liquidity. Liquidity refers to how easily an asset can be converted into cash without significantly affecting its value. Cash is the most liquid asset, while real estate or collectibles are less liquid. High liquidity is important for meeting short-term financial needs or taking advantage of investment opportunities. 22. FICO score. A FICO score is a widely used credit score model developed by the Fair Isaac Corporation. It ranges from 300 to 850, with higher scores indicating better creditworthiness. Lenders use FICO scores to assess the likelihood that a borrower will repay loans, influencing loan approvals and interest rates. 23. 401k. A 401k is an employer-sponsored retirement savings plan that allows employees to contribute a portion of their salary to a tax-deferred investment account. Employers may match contributions up to a certain limit. Over time, the investments grow, providing a source of income during retirement. 24. IRA, Individual Retirement Account. An IRA is a tax-advantaged retirement account that allows individuals to save for retirement. Contributions may be tax-deductible, and the money grows tax-deferred until it's withdrawn. IRAs are a key tool for building retirement savings outside of employer-sponsored plans like 401ks. 25. Roth IRA. A Roth IRA is a type of individual retirement account where contributions are made with after-tax dollars, meaning withdrawals in retirement are tax-free. It's especially beneficial for individuals who expect to be in a higher tax bracket during retirement, as it provides tax-free income in later years. 26. Capital. Capital refers to financial resources or assets that can be used to fund businesses, investments, or other ventures. It's essential for growth and expansion, as it enables companies to invest in equipment, research, and other resources. In personal finance, capital can include savings, investments, or property. 27. Diversification. Diversification is an investment strategy that involves spreading investments across different asset types to reduce risk. By holding a variety of investments such as stocks, bonds, and real estate, you can protect your portfolio from significant losses if one investment underperforms, thereby improving long-term returns. 28. Mutual fund. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professionals, mutual funds offer individuals access to a broad range of investments and diversification, making them a popular choice for retirement accounts. 29. ETF, Exchange Traded Fund. An ETF is an investment fund that trades on stock exchanges, similar to stocks. ETFs typically track an index, commodity, or asset group. They offer diversification and lower costs than mutual funds, while providing the flexibility of buying and selling shares throughout the trading day. 30. Compound interest. Compound interest is the interest earned on both the initial principal and any accumulated interest. Over time, this leads to exponential growth, making it a powerful tool for building wealth. The longer money is invested or saved, the more compound interest can work to increase returns. 31. Recession. A recession is a significant decline in economic activity, lasting for several months or more. It's characterized by reduced consumer spending, higher unemployment, and lower production. Governments and central banks often respond with stimulus measures to revive the economy and reduce the impacts on businesses and individuals. 32. GDP, Gross Domestic Product. GDP measures the total value of all goods and services produced within a country over a specific period, usually annually or quarterly. It's an important indicator of a nation's economic health. Higher GDP growth suggests a thriving economy, while declining GDP can signal economic challenges. 30. Equity. Equity represents ownership in an asset or company after liabilities are subtracted. In personal finance, home equity is the difference between the property's market value and the outstanding mortgage. In the stock market, equity refers to shareholders' ownership in a company, giving them a claim on profits. 34. Tax bracket. A tax bracket refers to the range of income that is taxed at a specific rate. Progressive tax systems have multiple brackets, meaning that as income rises, so does the rate at which it is taxed. Understanding tax brackets is important for effective tax planning and maximizing savings. 35. Estate planning. Estate planning is the process of arranging for the transfer of an individual's assets after death. It involves creating wills, trusts, and other legal documents to ensure that your property is distributed according to your wishes and to minimize taxes and legal complications for your heirs. Thanks for watching the video. Please subscribe.